Hey everyone, welcome back to my channel. Today we are doing a video on how to place a trade. How to place a trade. So maybe you are a new investor. Maybe you have never done it before. You're kind of getting into the groove of things. So we're going to go into kind of the different rules, the different order types, how you can go about to ensure that you are comfortable and that you hopefully don't lose a lot of money or you hopefully don't make a mistake. So welcome to my channel. Please comment, like, or subscribe, and let's get started. So when you go to place a trade, you have buy or sell options. We are going to start off with a buy option. So what that means is that you are essentially buying a stock, an ETF, a mutual fund, for example. And let's say you have $100. We're going to work with small numbers just to make it a little bit easier. So you have $100 and the price of the stock, let's say, is $10. Okay? So that means that you can then buy 10 shares. Okay? And then that would get you exactly to your $100. However, you do need to keep in mind something like your commissions. Okay? So because commissions can vary quite a bit, you have it from about $5 to $10. That means that you can't quite buy 10. You need to have a little bit of a buffer. So you either need to decrease the number of shares. Oh, there goes my lighting. I think it's all good. You either need to decrease the number of shares or you need to increase the amount of money that you have if you want to buy that amount of shares. So let's say in this case, we are going to stick with the $100, but now instead of 10 shares, we are going to buy 9. What you're going to do is place a trade for 9 shares. Now, how much are they going to be worth? Now, that's the thing that we don't quite know, because every time you refresh your page, the value of the shares is going to change. So it might go from $10 to maybe $9.95. Maybe it'll go up to $10.01. Maybe it'll go back up to $10.10, etc. So the amount can actually vary and fluctuate, right? So you're not quite going to spend 9 times 10 and spend $90 on shares. It might be a little bit lower or a little bit higher. If you are okay with that fluctuation, that is called a market order, okay? So in this case, market order means that there will be fluctuations with the price. Technically speaking, although the chances of it happening are slim to none, if the value of the share goes up to like $11, $15, $20 within that second when you place the trade, you can get filled at that price. So a market order does have fluctuations. However, the main reason why people do it is speed. Your time, your execution is quite fast. So essentially whatever someone is selling it for, that's what you are buying it for. So market order will have some variations, but speed is the main one. If that scares you a little bit, if that gives you too much risk, you can go into a limit order. So a limit order essentially has you input the maximum price you are willing to pay in the case of a buy. So for a buy order, it is your max price. Now what's important to know is you can get filled at that price or better, meaning or lower. So if you put in, let's say $10, it means that your trade will not go through if the value of the stock is higher than 10. That is the absolute maximum you are willing to pay. So let's say if the value of the stock starts to go up, let's say like $10.10, $10.05, something like that, your order is just going to sit and wait. It's going to sit and wait in the queue until it comes back down to $10. Now there is technically a risk that if the value of the stock continues to go up and it never hits $10 or less, then you have now missed out on that opportunity. Your order will be canceled. However, in this case, you have more control. So you are giving up speed for control. If when you put your trade, you put in a limit order of $10 and the value of the stock, let's say, goes to $9.95, it could very well be that you buy your shares at $9.95. Okay, so there is a little bit of fluctuation with the price. It's not exactly $10 you'll get it filled at, but the maximum that you'll pay is $10 in this case. So again, you have more control. However, you have less time. Okay. So those are the two main ones. There are different ones as well. They're a little bit more complex, so I won't get into them. However, when your order goes through, there is something called T+2. So what that means is it's kind of like a credit card, how there's usually 2 days for it to settle. There's also 2 days for your order to settle within your account. So what that means is you will see once your order gets verified and confirmed, you will see it in your account, but it'll actually just take 2 days to officially settle. Okay, so that is your settlement time frame. Now, when you place your trade, you also have time. So you can choose how long you want your order open for. So there is good till day, GTD, and that means until the end of the trading day. So that is until 4 p.m. And then you can also choose additional days as well. So you can choose if you want to wait like 2 weeks, if you want to wait maybe like a month, okay? Or if you want maximum time frame, that is considered GTC, or good till cancel. Okay, that maximum time frame depends on if you're looking at a Canadian or a US stock. So for Canadian stocks, it's 90 days. For US, it's double that. It's 180 days. Okay, so that just essentially means you're going to wait as long as possible for your order to get filled. Now, if your order is canceled, there is no commission. Usually, I think a lot of times you do need to double check your brokerage, but usually if there's no commission if the order doesn't go through. Okay? If the order is canceled. So even in this case, if your order is open for 90 days or 180 days, and then it doesn't get filled because maybe that price that you put in, maybe you put in a limit order that it never reached, you probably won't get charged. But again, you need to double check that. You'll also need to double check the account that you're placing the trade in. Okay, do you have enough money in it? Okay, so you will choose your account. You'll also choose the stock, okay? And then from there, you'll choose if you're buying or selling. And then you'll choose your order type, okay? And then potentially, let's say if it's a limit order, you'll choose the price point as well, okay? And then you'll choose your time frame. Now, the commission is going to be baked into this, right? So let's say, going back with the original numbers that we were working with, if it is $10 a trade, okay, and you buy 9 shares at $10 per share, that means, oh, we're running out of space here, that you're going to be doing 9 times 10, so $90 is your book value. And then you need to add on the $10 as well, commission. So this is actually going to be baked in to your average cost. So your book value isn't going to be $90. Your book value is actually going to be $100. Now for tax purposes, that actually makes it even more beneficial. So after you put in all of the information, you'll likely have a preview button that will tell you the cost of it. And then you'll go ahead and confirm and submit. And then you can check your order status as well to see what's the status. Has it been canceled? Is it open and waiting in the queue? Quite a few things. So hopefully that makes sense. I'm sure that your bank or whoever you bank with probably has maybe some videos or a little bit of information that you can read up on. Placing your first trade can be a little bit scary. Obviously, no one wants to lose money or make a mistake, but hopefully this helps to explain some of the key things that you'd be looking at. So that's a wrap. So I hope you learned something new. If you're still here, then it probably means that you've watched the whole video. Please give it a like, comment, or subscribe. I'll see you in another video. Have a great day, weekend, morning, evening, wherever you are. And I'll see you in a future video. Thanks for watching, everyone. Bye for now.